Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carroll Massar and Tim Stenovec from Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. Tim is out this week with me in from London. Lovely to have Stephen Carroll. He's co-host of Bloomberg Daybreak Europe on Bloomberg Radio. Really nice to have you here in a week.
Thanks for having me.
Where so much was going on globally.
I only arrive for important events.
He does. So I hear. Well, our backdrop on this busy past week, gridlock in New York City. No doubt about that. This as the 79th Annual UN General Assembly was in session, coinciding with New York City's annual Climate Week Summit. With global leaders in town, Bloomberg and Bloomberg Philanthropies, both founded by Michael R. Bloomberg, hosted the Bloomberg Global Business Forum and Earthshot Prize Innovation Summit at the Plaza Hotel, where we did a live broadcast.
Yeah, over the next 2 hours, we'll bring you some of our conversations and highlights from the event. These are discussions focusing on innovation and opportunity in the climate space, as well as tracking where the investment is going and how it all fits into the state of the global economy. On that, we have an update on Latin America and the Caribbean with Inter-American Development Bank's Jordan Schwartz, and the latest on the surge in wind power with the CEO of the Global Wind Energy Council, Ben Backwell.
And later on, the Australian billionaire who is spending billions on EV trucks. First up this hour, as Managing Director of the International Monetary Fund, Kristalina Georgieva is a leader on the world economy, its growth, its stresses, and its complicated relationships. And so, coming off of the Federal Reserve's half-point interest rate cut decision last week, she told us the Fed broadly got it right. Here's more from the Bloomberg Global Business Forum in New York.
Well, the global economy has been remarkably resilient despite the horrendous shocks of the last years. Despite of interest rates fighting inflation for the last more than a year, we have seen global growth holding. We project 3.2% this year, 3.2% next year. The two engines of this performance, US economy and most of emerging Asia, especially India, ASEAN. We are now seeing interest rates in most economies going down, and rightly so, because we also see the price being paid for interest rates being high. It is affecting somewhat prospects for growth in major economies. Two very important points for your audience. Number one, yes, growth is holding, but by historic standards, it is not high enough to retain good prospects for our economies. Before the pandemic, average growth, 3.8%. Two, we also have very high debt levels. And that combination of slow growth and high debt is something that we at the fund worry about. What we want to see is countries taking seriously the importance of fiscal prudence. So the central banks have done their job. They fought inflation. Inflation is going down. Rates are going down. We need the fiscal side to be equally committed. And of course, we want to see more attention as to what drives growth up.
I want to go back to inflation, though. With the Fed finally making that big move last week, that half a point cut, inflation defeated, mission accomplished, done? Or would you say not necessarily yet?
Watch it. Yes, we are in a very good place. We have been predicting soft landing. We would see inflation down and growth still remaining firmly in positive territory. This is where we are.
Right.
We know that in the services, inflation is still flaring a little bit more, so the Fed is going to watch it. But broadly, we think that the Fed got it right, and we would see how that evolves in the next meeting of the Fed. Not to exclude there could be more cuts. But again, Why is the Fed successful? Because it is data-driven. So they would watch incoming data very carefully.
I take note that you're worried about the fiscal side, though. How big a risk is what you're hearing in the US election campaign? That's going to have a huge impact on US fiscal policy.
Look, I mean, let's first give credit where credit is due. The US has helped the world economy to stay afloat in this very difficult time. So when we think about the response to the pandemic, the response to the war in Ukraine, the spike of energy and food prices, having the US economy to perk in the way it did, a very good news for everybody. This being said, we have to all think of the beast that may be around the corner. What we learned in these last years is that we are in a more shock-prone world, and having fiscal space to act should that become necessary is a message we send to all our members.
Is that our number one risk, though, the fiscal position of the United States and other?
Well, I mean, the United States has the ability to fund itself in a fairly comfortable manner.
Right.
What we see in some other countries, they don't quite have that privilege. So the pressure for imminent action, of course, differs in different places. We have been saying that make sure that you are not pushing prices up by getting more money into the economy.
Too much stimulus.
Than the economy can handle. So be careful.
But you don't worry about with the U.S. Federal Bank in particular, that by that half a point cut, that they maybe are putting a little bit more stimulus when the economy seems to be doing well, right? There's growth.
Yeah, the economy is doing well.
The labor market's still
some
okay.
Some of the signs you actually are reporting in your program that consumers seem to be saying, well, we're not as confident as we were before. Let's remember that when you have interest rates so high, that has impact. And it is the desired impact to bring inflation down and the accompanying not so desired impact on consumer and business confidence. So my message is the following. We have to all be very watchful of whether there is risk of inflation to flare up again. What is happening around the world.
Right.
So we are not, I mean, as the movie would go, we are not in Kansas anymore. We're in a different world, more shock-prone, more unpredictable. Keep your powder dry. Don't use all of it at once.
One of the shocks that did upend the global economy was Russia's war in Ukraine, and the fund was criticised recently for planning to restart annual economic consultations with Russia. Whose idea was that?
Look, I mean, we do have an Articles of Agreement, and they say you have to have regular consultations. The Russian case is a very complex case. This is not your normal Article 4. So, as you know, we have said we need to see whether we have all the data, we need to see whether we are ready, and at this moment, we are not.
But does that damage the fund's reputation, having that sort of confusion around starting and then stopping?
I think that the fund has been incredibly strong over this period of time of shock upon shock upon shock. We have supplied liquidity to countries that need it. We boosted reserves for countries so they can go through these shocks. And I think our reputation speaks for itself by the fact that our membership is increasing. We just got our 191st member, the tiny country of Liechtenstein, joining us. Why? Because we are an anchor in a sea of trouble. So I would argue that when you look at the fund, you have a credible institution. We have come through. We help the world economy to steer through very difficult time. We will continue to do that.
But is it tricky considering the war and in terms of advising Russia, like how to survive through this when most of the developed world, as you know,
of course it is
think it is a horrible war?
My heart bleeds for the people in Ukraine that have been so harshly hit by Russia's war. I want to see the war ending for the sake of Ukraine and for the sake of the global economy. It was incredibly damaging to the whole world. When we think of this, is it possible to do Article 4 without enhancing Russia's capabilities? We have to sit back and think twice. And this is what we are doing right now.
How long will you wait before that issue?
And why are some of our members, I mean, this is our dilemma. Some of our members are saying, please, you're the only institution, not Russia, other members. They're saying, you're the only institution that can come up with some credible assessment. What is happening in Russia? So that is also something that is in the equation. But I'm telling you, this is not an adventure we would take ever lightly. And I care very deeply for the trust of my membership. We need to be there as an institution that holds strong in a world that has more trouble.
I want to ask you about Argentina, because you guys have put in, there was some complaints by the Argentinian president about the IMF negotiator. You put in a new negotiator. And we do wonder about, like, what does that signal to other countries when they're maybe not happy with negotiations or policies or the IMF?
So the answer is very simple. It is the negotiator himself who found the situation being complicated.
Yeah.
How do you negotiate with somebody who does not trust you at all? So it was that negotiator that looked into the situation in Argentina. Does Argentina need help from the fund? Yes. Do they need our advice? Yes. Let me send somebody who the president would listen to. And I can tell you that that was a mature judgment, and I stand by this judgment of my staffer. Great professional, Rodrigo Valdez. I admire him for the maturity he has shown in that environment.
And are you hopeful for improved relationships with Argentina as a result of that change? Will things proceed more smoothly with the IMF's relationship there?
Argentina faces very, very tough problems to solve. And I know that Argentina would only benefit of having the IMF analytically to stand by Argentina and financially to stand by Argentina.
Madam Director, I don't know if you realize it, but there's an election going on in the United States. And I am curious. You've got two candidates with radically different positions on a lot of different issues, whether it's trade, immigration, the U.S.'s position on the global stage. On economic policy, what's your advice for the next president of the United States?
Look, I mean, the elections in the United States, this is the choice of the American people. They make this choice. They have a president. And then this president sets up an agenda for the country. We are always there for our members to give them our best shot advice. So
are your members worried about the outcome of the U.S. election?
The whole of the membership is now faced in a world in which 60% of people are going to the polls.
Yeah.
You ask different countries, they have different worries. But there are also very amazing stories that I hope you would tell. I was with Professor Yunus of Bangladesh. Here is a country in which the youth of the country said, no more corruption. We want to turn a page. And for us, supporting this country to turn that page, to get a good growth and good prospects for their people, amazing.
So listening to the younger population, always important. Kristalina Georgieva, thank you so much. We so appreciate your time here. Managing Director, of course, of the International Monetary Fund. Thank you so much.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
We are very global all this week here on Bloomberg Businessweek, and we've had this week the opportunity to focus on economic issues in different regions of the world and how the changing climate is altering many countries' trajectories. Well, the African Development Bank finances projects across the continent in areas including agriculture, energy, also the private sector development. And we know those African countries, something we talk about a lot here at Bloomberg, are among those most affected by climate change. So that is some of what we wanted to talk about here on Businessweek.
Yeah, indeed. And to discuss it, we're joined in the Interactive Broker studio by Dr. Akinwumi Adesina, who is the president of the African Development Bank. Thank you very much to see you. We've also got Bloomberg's Chief Africa correspondent Jennifer Zabasaja with us in studio too to join the conversation. Dr. Adesina, welcome to New York. Great to have you here. You're here having conversations with global leaders for Climate Week and the UN General Assembly. What are you trying to get out of this week?
Well, first and foremost, is just to make sure Africa's issues are on the top of the agenda. Because when you talk about climate change, Africa only accounts for no more than 3% of total emissions, but actually suffers disproportionately from the negative consequences. It loses $7 to $15 billion a year. And if the current trend continues, that's going to rise to $50 billion a year. But it's not getting the amount of financing that it needs. You know, Africa needs roughly about $277 billion a year to tackle climate change, but it gets no more than $30 billion. So there's a big gap there. So, but most of what is needed there is really to adapt to climate change. It's not so much on mitigation, but it's about adapting to climate change. The other thing that I wanted to get out of most of this is actually how we tackle Africa's debt issues, because at the end of the day, you know, you can't run up a hill if you're carrying a backpack of sand. And so you can't have development in which you have highly indebted countries. And so we have to make sure that African countries facing a lot of challenges in terms of climate, in terms of also conflict, also in terms of high inflation and strengthening fiscal space, that they have the space they need to be able to invest in education, health, water sanitation, girls' education, and all of those things. So debt, climate, for me, are very, very, very important part of my conversation here this week.
And Dr. Adesina, I mean, part of that, I want to start with climate change maybe because you have talked a lot about, in particular, the IMF special drawing rights and channeling more of those towards addressing climate change on the continent. Where is the progress on that? Did you make any progress this week while here in New York?
Well, actually, just to think about the special drawing rights of the IMF, you know, when we started, everybody thought, well, SDRs were things you put on the balance sheet, essentially as reserve assets of central banks. But we felt that actually these assets were actually simply latent assets, that I was convinced that we can actually do better in terms of seeing how we can turn those into assets that can unlock a lot of capital through the multilateral development banks. And the model that we developed basically was, you know, to say, okay, if you actually rechannel the SDRs to us as AAA rated financial institutions, that's actually a hybrid capital that we can use. And it's a perpetual thing that stays on our balance sheet. So we can actually leverage that 4 times. It can even go to 4 to 8 times. And so we are very delighted, myself and the president of Inter-American Development Bank, we worked together very collaboratively to solve some of the because there were some technical issues about what's the reserve asset status of it. And if you want to collect it back, how can you get it back? So we had to deal with some technical issues. We solved all those technical issues, and I was delighted that the IMF board actually approved $20 billion of SDRs to be rechanneled through the multilateral development banks as hybrid capital. Now the issue is how do we get that money out? Yeah. So to get all that money out,
how do you?
Yeah, exactly. You know, we had to actually put together a group of 5. We need 5 SDR-rich countries that will agree to rechannel that through the African Development Bank and the Inter-American Development Bank. But also we have to make sure we have a group of others that are in Europe. For example, European countries can't do it because of restrictions by the European Central Bank on monetary policy outside of the EU. And so, but we set up a very nifty structure, which is called Liquidity Support Agreement, in which they can just essentially guarantee those that are giving it to you. Okay, that's still allowed. So that's where we are. We're making progress in terms of the countries. We're talking to them. And I'm hoping that, you know, by the time we do G20, we'll have gone a long way in making sure that's realized.
Long way, or will you actually have access to the funds?
Well, actually, you know, the long way is to get access to the funds. So, which means there has to be agreement. That thing, it's not just easy. Just like I gave it to you, there are legal things they have to go through in their countries to make sure that gets done. So we know that President Lula, as the presidency of the G20, as I spoke at this event just yesterday, that the SDRs used, for hybrid capital and getting it out to us is top on the agenda for G20.
This is something that, I mean, we're deep in the weeds of international financial machinery here, and how the money gets
Great.
reallocated.
This is what we like to do, educate the public.
This is something, I was at the EU Africa Summit 2.5 years ago when this idea was sort of advanced to a level where the reallocation would be able to happen. The political will was there from under Emmanuel Macron at the time. Is the political will still there to action this and to make sure that transmission happens as quickly as possible?
Well, remember, there are two things we're talking about here. That is the one in which there was a request to make sure that some amount of money actually given, through the IMF, through its poverty reduction and growth trust and resilience and sustainability trust. So that's money that's being given to IMF. Yeah. That's a different thing. The one that I'm talking about, and that's going very well. I think they have probably the $100 billion they're looking for of SDR. The one we're looking for is how the SDRs gets rechanneled through the multilateral development bank, so we can actually leverage that. The thing is that when the money goes to IMF is very, very great. Kristalina, my sister, has been enormously helpful. But for us, it's a wonderful thing. Every dollar becomes $4. It's good for you as a shareholder. It's good for the taxpayers, and you don't lose all the money. And so the progress has been made. This phenomenal progress has been made. But I think we just have to tie the knots and make sure the money actually comes home, and we can continue to do it. I just tell you one thing that I can do. I take the case of RJ Banga, president of the World Bank, and I got together during the spring meeting, and we said, look, we still have 600 million Africans that don't have access to electricity. Right. That doesn't make any sense. You can't grow in the dark, you can't industrialize in the dark, and you cannot be competitive without electricity. So I said, we're going to have to deal with it. And so we both agreed, and we launched what's called Mission 300, which is to connect 300 million Africans to electricity by 2030. Now, universal access to electricity in Africa is going to require $190 billion per year. Now, here's where the SDR connection comes in. Mm-hmm. Because if you actually have $50 billion of SDRs, and you can leverage it at 4 times because it's a hybrid capital for you, that means that problem is solved once and for all. That is $200 billion at least to solve that problem. So that's the connection that we are trying to make. And President Lula, as president of the G20, is also we've raised the issue also about he has something called the Global Alliance Against Poverty and Hunger. Okay, and so it's the same thing. You use this SDR as well. You unlock massive amount of capital to deal with all the things we say we have a pact of the future.
So do you think that within 6 months, 12 months, you have that capital that you can move forward? I
believe that we will, because I think that the most difficult part, we've gone over that. Okay. So it's a question now of how we're going to use it and how we can get it out. So I think so, yes, absolutely, yeah.
Well, one of the other things, I'm just curious about other parts of the world where you look to access, partnerships money. You guys have been working with the Arab Bank for Economic Development on some key projects. What can you tell us about further expansion there? We're also curious about, the relationship with China and money coming in from China. What can you tell us in those two aspects?
The Arab Bank for Economic Development in Africa is a very great partner of the African Development Bank, and we have joint projects that we do together.
Will you do more?
Oh yeah, we will do more, and we work in education, in water, in sanitation, in agriculture, and infrastructure, and so on. And so they just celebrated their 50th anniversary. I was one of their keynote speakers to speak there. They've also invested in one of the things that we put up called the Alliance for Green Infrastructure in Africa, which is a vehicle that we just put together to mobilize $10 billion of private capital going into greening the infrastructure space, greening the green transport, green hydrogen, green ammonia, and also making sure that we can basically have climate resilient infrastructure all across Africa. So we have a lot together. We've done, together about almost $835 million of joint projects in the last 7 years, and we've put in $600 million into that. So we are great partners, and I look forward to us doing more together.
What about China?
Yeah,
which we know over the years we've talked about the investments China has done.
Yeah.
Some of it, they're concerned about their access certainly to raw materials, basic minerals, and so on. So what can you tell us on that front?
Well, I think China invests quite a lot in infrastructure in Africa, and people get to ask me a lot of questions about that. But the question really is that Africa's infrastructure gap is so massive. Africa needs at least $60 to $108 billion a year Not to
a
talk
whole
of,
different
not to
scale.
talk of even the challenges you have. You're doing the infrastructure, and all of a sudden you have all these cyclones and hurricanes and all these things that are happening. That's actually setting you back, right? And so, but I think that what has happened is on the infrastructure space, what I just note more generally is a lot being done by governments. And I don't think that infrastructure should always be carried by governments. I think you need to have a lot more private capital moving into infrastructure. Right. I think you have to make sure that the debt burdens from infrastructure are reduced. I also think it's very, very important to make sure that the infrastructure being done, in any case, should be infrastructure that you can recycle. In other words, governments, if you've actually taken a lot of loans to do infrastructure, why not just do asset recycling? Basically, just recycle that into private sector and then free up more capital to be able to do more. Right. And so that's how I look at it. And I think that for us at African Development Bank, in the last 7 years or so, we've put in more than $55 billion into Africa. We are the largest by far multilateral financial institution investing in infrastructure.
Right. When you talk to international investors, Dr. Adesina, I know you were meeting with a few of them while you were here this week. I mean, what is their concern? Because we hear a lot about risk in investing potentially in a lot of these infrastructure projects that you're talking about. I mean, what is it that international investors are hoping to see in order to penetrate more into more of these markets?
Yeah, if you take a look at it, we don't get that much of private capital moving into infrastructure, right, in Africa. But the issue is, people talk about risk. Well, life is about risk return. People forget about the return part of that. And so it's a risk-return world. And I take a look at Africa, and I don't think Africa is riskier than any other part of the world. Don't believe me, just believe the data. There was an assessment that was done by Moody's Analytics, who looked at the cumulative losses on infrastructure financing globally, not just in Africa. And what did they find? They look at 14 years of non-performing loans and debt, and they found that in Africa, the non-performing loans was 1.9%. In North America, it was 6.6%. In Latin America, it was about 10%, and in Eastern Europe, about 12.4%, and Western Asia almost 4.5%. So Africa is not as risky as people say. Perception is not reality.
How do we change that perception? Because I think you've got this really smart global audience right now, and I think we think of emerging world and we think, oh yeah, Africa. What's the message you would like to get out to the audience who's listening right now?
Well, first and foremost is that the fact that I said it's about risk return, well, doesn't mean there are no risks. Right. So first and foremost is that we have the vehicles to de-risk those things. So we have project risk, market risk, and whether there are also political risk insurance that we can actually provide. In fact, at the African Development,
some say we have a little political risk too, but go ahead. Continue.
But we can't de-risk that. So I'll stay within my lane. But we're trying to put all of our instruments, so partial risk guarantee instruments, partial credit guarantee instruments that we do for counterparties, whether government or private sector. We're trying to pull all that together into what we call an African insurance and guarantee agency. So private sector needing those risk instruments don't have to run in everywhere to lower their transaction costs to do it. And that will be a game changer, because it will also provide insurance against equity investments. It will provide insurance for you when you actually also have political insurance, and insure you against climate shocks. And the last thing I'll say about this particular thing is just that when investors are looking to invest, they're asking the question, where are the bankable projects? Right? You have to be able to have a whole series of bankable projects. And we're doing very well on that. We have, for example, an institution that I actually chair its board. It's called Africa 50. It's a private equity vehicle that has about now $1.1 billion and portfolios of $8 billion on infrastructure assets. Wow. And basically what it does is, it's as part of a company, it's called Project Development Company. And so it develops bankable projects that it can sell, right? It doesn't matter what it is. So we're trying to make project development a business issue, not just a development issue.
It's the financial, the private sector involvement, right?
That's right. And the last thing I'll just say about investing in infrastructure, it's important of local currency financing. We talk about debt just now, but if you actually look at the assets that people are investing in, the revenue streams are going to be coming in local currencies, and the currencies are actually depreciating very much. So local currency bonds are going to be very important for financing that, and also synthetic local currency instruments are going to be there, and as well as, we at the bank, we support financial institutions in Africa that actually lend in local currency, but we take the we actually insure you. We give you the risk. You lend it, and we bear the risk ourselves.
Right. We're seeing a lot of that volatility with currencies all over the continent. Dr. Adesina, we were just talking briefly about how this is your last UNGA as president of the African Development Bank. I wonder how you think about your time in office over the past decade or so. You talked about how the bank looks a lot differently than how you inherited it. I mean, how would you assess it?
Well, first and foremost, it's the greatest honor of my life to be asked by shareholders. We've got 81 shareholders to go, and actually you have the resources, you have the confidence, you have the support, and guess what? Go change the continent of my birth, and that's not for me a job. That is a mission. I take it as a mission, and so that's how I look at it every single day. Now look at what has happened to the bank since we actually started. For example, when we started, I said that we have to have a clarity about how the bank tackles issues, day-to-day issues of people. People shouldn't really looking at, you have African Development Bank. The issue for me is not just the bank. We know how to run the bank. It's the issue, it's the development part, right? Mm-hmm. And so we actually set out to actually say 5 priorities for Africa: light up and power Africa, universal access to electricity, feed Africa, integrate Africa infrastructure-wise, industrialize Africa so Africa can be competitive with global value chains, okay, and increase its share of global manufacturing. And then, of course, improve the quality of life of the people of Africa, the things that we all care about: water, sanitation, education, skills, jobs for young people, and all of that. So we, in the last since the last 7 years, that work has impacted on more than 400 million people. And second is what we've done in terms of raising more capital for the bank. When I was elected president first at the bank, my first term, the capital of the bank was $93 billion. Today, the capital of the bank is $318 billion.
It's a big difference.
And last year, just one point, last year, the African Development Bank was ranked as the best multilateral financial institution in the world. And last year and this year, we were ranked also as the most transparent financial institution in the world. So I think that, we've done pretty well. I think my staff have been fantastic, but most importantly, my shareholders have just been phenomenal. When I was reelected, with 100% of the votes, so which was fantastic.
Well, it's certainly a part of the world that we focus on so much. Jen knows this, as she spent so much time on it as well. Dr. Adesina, thank you so much. Thank you for finding time for us. Jen Zabajaja, thank you as well for joining us and on this conversation. That's going to do it. Of course, the president of the Africa Development Bank. If you missed any of the conversation, be sure to head to Bloomberg.com to hear it.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This past week's Bloomberg Global Business Forum gave us an opportunity to hear about what is going on in the global economy, both the developed and developing worlds. Last segment, we talked about Africa. We shift now to another emerging part of the world, Latin America and the Caribbean. The World Bank forecasts that regional GDP in those countries will expand by 1.6% this year and 2.7% in 2025.
Look, these rates are the lowest compared to all other regions in the world, and they're not high enough to drive prosperity. According to a United Nations Development Programme report, the economies of Latin America and the Caribbean are more susceptible to external shocks, with this volatility affecting this region more than other developing economies.
And this is why this next conversation was so important. Jordan Schwartz is Executive Vice President of the Inter-American Development Bank and knows about the challenges of these regions. He's also Chief Operations Officer of IDB, oversees the quality control and risk management of all bank operations of financing for Latin America and the Caribbean. Once again, from the Bloomberg Global Business Forum in New York City, here's IDB's Jordan Schwartz.
Where are the economies that you're focused on now in terms of a post-COVID recovery? What's the outlook? What is 2024 looking like for them?
It's a great set of questions. The Latin American Caribbean region is very heterogeneous. Not surprising, right? We have the Caribbean islands, relatively small economies, generally single commodity dependent. In this case, the commodities often are tourism, if you will. Mm-hmm. And we have big complex economies like Mexico, Brazil, Colombia, Argentina. So it's a heterogeneous region, but it's a region that has been, I think, struggling to maintain and to increase its level of economic growth, of GDP growth over the years, to provide the kind of opportunities and services that the population has grown to expect. It's a middle-income region overall, but it still has vulnerability, important vulnerability It has a few low-income countries, Haiti, for example, Honduras, and others. But it's generally a middle-income country. And I would say a theme of the day for us, a theme of the multilaterals that work in the region, particularly the Inter-American Development Bank, intermediating on the capital markets, trying to bring long-term financing for development, both public and private, into the region, is how to help the region take advantage of its comparative advantages, to leverage its comparative advantages. Its food production, for example, the region already produces probably 3 times as much as the food that it consumes itself. It produces energy. It has a very green matrix. It has a large hydro base. It has geothermal. It has all kinds of renewable resources. It can be part of the solution to the global energy transition, part of the solution to global food security. And to be able to see investment into those areas and the growth of those areas, I think, will be part of helping the region return to a higher level of growth in the years ahead.
Jordan, what holds it back then? Is it the case that over the years, over the decades, because I feel like we've been talking about, let's take Latin America in particular, or even a nation like Haiti, gets caught in the policies of other countries. What is it that holds it back?
I would say...
and I hate to lump them all in one basket.
Yeah, that's a negative question. I have to find a way to make this positive.
No, I'm not trying to be negative. I'm trying to be smarter. How do we find a smarter way forward?
I think part of it is regional integration. So the economies of scale and scope that come with greater interregional trade, with the trade of energy, with the trade of goods, so that you can tease out the productivity, the competitive potential of the economies. It has overall been a region that has been somewhat atomized and hasn't brought together its own trading systems. That's probably part of it. I would say it's a vulnerable region. It's vulnerable to climate, to weather effects in general, particularly the Caribbean, Central America, but also increasingly, as we know, those commodity exporting countries that are suffering from drought, suffering from flooding, often suffering from flood and drought, increasingly at the same time in large weather events. So it's a vulnerable region. It has more to do in terms of bringing itself together. And I think probably there's a whole theme we could get into if we had another 6 minutes sometime to talk about competitiveness and the way in which the economies could encourage greater competitiveness or productivity.
We're very focused on climate here today. Obviously, we had the Earthshot Innovation Summit earlier on, the Global Business Forum happening as we speak. When you're looking at projects to support across the various countries that you work with, climate resilience, what are you looking at? What sort of projects are you involved in? Where are you seeing success?
It's a brilliant question. Listen, for us, we look sort of at 2 sets of challenges at the same time. One is the box, the asset, the investment. What can be done in order to better manage the risk associated with investment? What role can the financial intermediaries, the multilateral development banks, with long-term finance, with guarantees, with our own sort of toolbox for investment, what more can we do in that space? But then we also look at the systems and the utilities, the policies, the pricing, the quality of regulation, the ability of the utilities to offtake that investment, what needs to be done in order to make prices more self-sustaining, the financial sustainability of the utilities, the capacity of the transmission systems to offtake, to absorb all of this energy that's coming, and to deal with the intermittency of renewables. We are both a policy institution and an investment institution, and we're helping our client countries when we're dealing with both things at the same time, what goes into that investment and the environment in which the investment is being made.
Do you have all the financial instruments that you would like to be able to tackle some of the issues, especially when they're cross-border issues and you're dealing maybe with a couple different countries?
It's the cross-border issues oftentimes are not solely financial. It's about the integrity of contracts, about regulatory integrity, and the ability to trust and maintain the purchase back and forth or the trade back and forth of energy, as an example. The question about financial instruments is really interesting to me because we have been focused on financial innovation even as we are trying to assure the impact of the investments that we make, right? Because there's sort of 2 things. There's the instrumentalization. How do I spread out risk and manage risk better? What are the tools that I can use to do that? When do I deploy credit enhancements, guarantees, strengthening of offtake agreements, termination payments for power? But at the same time, what do I need to do to protect the consumer What do I need to do to protect the natural capital of the in the environment of the investments? What role does multilateral have to make sure that whatever money we've mobilized can actually be paid back over time?
Right.
It's actually driving economic growth, the capacity of consumers and taxpayers to pay back all that finance.
And to encourage more future investment.
And to encourage more. I think that's an important point.
How much are you working with private investors to crowdfunding for projects as well? I'm wondering if we can gauge investor appetite in some of the projects that you've been supporting.
The IDB has a private sector wing called the IDB Invest, and it has an early equity and venture capital branch called IDB Lab. IDB Invest, which is we're the only multilateral with that kind of risk appetite, derived from an early investment wing. On the IDB Invest side, it is recently been recapitalized, which means that the governments that contribute to it from Latin America, the United States, Japan, Europe, have agreed to functionally double the size of the capital available in this world in which the whole concept of multilateralism is sort of being challenged.
Yeah.
We see a recognition that actually the private sector's got to be a major part of. So we have this vehicle, we have this institution, it's going to be doubling in size, and the balance of the IDB group is basically going to change so that it will be even slightly more than half private finance and the public sector side, the sovereign guaranteed side, growing as well.
I wonder as well in the MDB space, competition, right? You have the Asian Infrastructure and Investment Bank, among others, who are also looking to invest in the same region as you as well. Is it a competitive environment? Are you all competing to kind of fund the same sort of projects?
It's interesting. We've seen this year a concerted effort and a lot of pressure from our own shareholders to bring the multilateral development banks closer together, to function as more as a group, as a unit, come up with platforms for investment. We're not competitive the way commercial banks need to compete with each other.
But can you work together? Do you have shared goals?
A large part of our financing is co-finance, particularly with the World Bank, which is very active in Latin America and the Caribbean, has sort of a similar set of protocols around environmental and social safeguards, transparency, procurement, competition, and the focus on rule of law. It's a somewhat similar culture, though we are unique in that 50.01% are owned by the borrowing countries, Latin America and the Caribbean. The United States has 30% ownership. This is how, in the Eisenhower administration, this institution was designed with this unique balance. And so we bring that to the table when we bring in other multilateral development banks, and of course, presence in every country. We're very decentralized, very client-focused institution.
You talk about, certainly the global country involvement and the collaboration, if you will, geopolitics or upcoming elections we've seen them all around the world, but certainly here in the United States as well, with someone who's very involved. How does that complicate what you guys are doing?
It's really interesting. We see ourselves not as a government, but as a stabilizing force, right? So when we're engaged, we're talking about the energy sector, but the same is true for the social sectors, for health, education. We spend decades working with these countries to develop their social protection systems, right? Their health and education systems, their power systems, and we bridge governments. Even when there's dramatic change in policies, we tend to help smooth the volatility of policy over time. That should be a function of a multilateral. We're there as partners for the growth. And even though the governments are our intermediaries, it's really the people of the country, it's the consumers and the taxpayers that we work for. And so I think we're used to seeing changes in political parties. We're meant to survive through those changes. And so hopefully we'll play that role going forward, Carroll.
Can I ask you briefly about the US election and what risk that could present, given that the US is such a big contributor to your funding?
I just have about 20 seconds.
No, it's a important question. We get on with our business, and we know and trust that consecutive administrations, as has happened in the past, support what we do and understand roughly what we do, and we hope to work with whoever comes in.
Jordan Schwartz, thank you so much. Executive VP, Inter-American Development Bank. Thank you so much for joining us here.
A pleasure. Thank you.
Pleasure is ours. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
All right, we are so looking forward to our next guest. He's got a great vantage point on the global economy, global mining, climate change. Just this past week, Fortescue, the world's fourth biggest iron ore miner, saying it will pay $2.8 billion to replace 2/3 of its fleet of haulage trucks and equipment in Western Australia with EV versions as it seeks to cut diesel consumption and meet ambitious emissions reduction targets. There's a lot going on.
Yeah, there sure is. And look, we've got lots to talk to Andrew Forrest about. It joins us in studio, Executive Chairman and Billionaire of Perth, Australia, based Fortescue, in town this week during the UN General Assembly and Climate Week as well. Welcome to Bloomberg Businessweek.
Thanks, Steve.
How are you?
I'm on fire, thank you. I'm just in an exciting place right now.
It certainly is. And look, at a time that we're going to talk about your climate transition plan in a moment, because that's a really interesting conversation, we spent all week talking about China and the stimulus efforts being made there, and this is a story that's very central to your business as well. Imported iron ore used in roughly 80% of Chinese steel production. Talk to us about the picture that you're seeing of the Chinese economy from your side of the business and the demand. How bad is it?
Oh, how good it is. I mean, basically, you've had mining companies being fat, dumb and happy for a very long time because the iron ore price has been so good, so we're all heroes. But now, oh my God, the iron ore price has fallen, which means it's a lot better value, by the way, for the customer. And we have to work a lot harder as miners. We have to work harder to actually make a margin. And that's a good thing. And when people think that one through, they think, well, how do I lower my margins? Well, 1/3 of my cost is diesel fuel. 1/3, right? One-third. Imagine if we could get rid of that. Oh, by the way, we'd also be going zero emissions if we did that. So we've been working on this for years and years and years. And to give you an idea of how strong that demand is, because people are looking hard at their operating costs now, we took years and years to get up a 360 truck order. Now, these are big trucks, right? You've got the hubcaps starting at the roof here. And we signed another 100 and got walk-ins for another 400 in a day. So from 3 or 4 years for 360, for a day for another 500. So this is showing you that the mining industry is saying, hey, we've got to really look at operating costs. And Fortescue, admittedly, is driven because it wanted to go zero emissions, because we bloody well have to as a human race. But then we also have to prove that it's highly commercial. And what you're seeing happen yesterday and today is that going zero emissions is highly commercial.
To say you're not worried about China?
No, I'm not. I mean, I've just come from China, but I get accused when I'm in China being very pro-North American, and when I'm in North America, I get accused of being very pro-China. So
no, but this is interesting because look, all of the narrative is
and love you both.
The narrative is so negative and has been for so long.
Are we wrong?
The slump in the property sector.
I'm afraid you're wrong. You are wrong. I mean. Here in North America, you have a completely different system. You get lag effects and lowering interest rates and things like that, and it's macroeconomic policy, and it works really well over a long time. If they want to hit the accelerator, hit the brakes, you see the impact straight away. So they did a little bit of priming, not much. I got to say, as a percentage of GDP, it'd be hard to measure it, but that has kicked investment straight away. It's kicked the iron ore price. It's kicked iron ore demand.
So 5% growth, not a concern. It's going to happen.
Look, I'm completely not worried about it. And by the way, if it's 4 or 6, I know big countries who'd love to get 2 or 3. So, for our demand, I'm seeing the iron ore price come down, and I'm saying good.
So Andrew, basically what you're saying is China's like, okay, if there still isn't enough, we're going to do more.
Yeah, and also, I love North America because we're aligned with North America. I love China because they're actually leading the world on going green. I mean, they are way ahead of their own plan. And North America and China kicking the hell out of each other is really bad for the overall human race. This geostrategic war between North America, precipitated, I want to put it bluntly, by North America. And look, China does all these things wrong too, and you can jump on their toes, but you jump on their toes in private. You don't do it by shouting at them from New York or Washington, D.C.
Well, does that then worry you about who's in the White House come November?
Fortescue has a policy that we deal with any elected leadership that you suckers want to put up, right? So, if you want to put up Trump, I've got to say this Ukraine badge, if there's a deal cut which rewards an invader for invading a country, which you've had as an enemy for 80 years, and you go cut a deal and reward a bad guy for being bad, we're down in the Pacific and we're going to say, hold the phone. If you're going to trade Ukraine against Russia, where do we sit with North America? I mean, where do we sit? I mean, who do we now call a friend if you're going to turn around and do that to Europe?
Right.
I mean, you're obviously very plugged into geopolitical tensions because it's part of what affects your business as well. When you're thinking about global climate solutions, and you gave us some of the outlines of your plan there as well, there's some people that are going to think it's highly ironic that a mining company would be looking at a green transition.
I agree with them.
What green iron ore, what is that? Do these things really make a difference when it comes to the bottom line of limiting climate change?
Yeah, let's start with 3 million tonnes of carbon dioxide not going out in the atmosphere. I mean, let's just start there. And then let's realise that no one's ever going to make green iron or green steel, which is 10% of the carbon budget. Now we're talking huge, unless you start with green iron ore. So the fact we're going to green iron ore within a few years means that we can then go to green iron or green steel. Now that's starting to have a massive impact, because if we do that economically, then the pollution, which is currently suffered all over the world, particularly in China, where they put their steel mills on the outskirts of their cities, central planned, but their cities grew so much bigger, so now the steel mills are inside the city. We send them totally pollution-free metal, their pollution problem goes out the window. So there is a really big impact on this slow, lethargic, backward industry called mining, ironically leading the world to go green. And it's hitting where the pollution is worst. And it's not saying, oh, well, we've got to continue burning oil and gas because there's such lovely people and we have to look after them. We're saying, actually, oil and gas has got us into this manure. We've got to stop doing what we've always done if we want a different result, and switch off the oil and gas, and then we'll get a different result. And that's like green steel. That's like green shipping. Now,
what exactly, though, is green iron ore? And what does it cost versus other iron ore? And is it cost competitive?
Yeah, no, it's going to cost less, ma'am. It's going to,
How
because
quickly?
we can make it for less.
Is it already?
Because we're not chopping through a billion litres of diesel here, like nearly 500 million gallons of diesel. We're not going to buy anymore, because we're making it ourselves. So,
is it cost competitive already?
Yeah, hell yeah.
Yeah.
Yeah. But that's the beauty of it, which is why I'm saying, listen, stop looking at going green. Stop looking at zero emissions as, oh, you're a really nice guy. What a lovely chief executive. What a lovely politician, thinking of the kids, not himself. Actually, get out of your hole. This is a great investment. You should be doing this for your shareholders. And if you say you can't go green, well, you're right. Get off the stage and let on someone smarter who can.
But why isn't everyone doing it if the case is that simple?
And done it sooner.
Because
it yesterday
everything starts somewhere, right?
Okay.
Everything starts somewhere. I mean, the suit you're wearing started with a thread, mate. It turned out to be a suit, so wear the thread.
Yeah. Talk to me about the conversations you're having here in New York as well. Are people getting the message?
People are getting the message. Yeah, I mean,
we look at the pullback on green agenda in so many parts of the world at the moment. We see it reflected in polling and in election results. Is that playing?
Yeah,
into
that's an opportunity for us.
Okay,
that's a serious opportunity. I mean, we are pushing ahead, going green as quickly as possible. We've got technology which can take the water in here, so to steal your water bottle, turn it into the most powerful fuel the world's ever had, which is hydrogen. When we turn it from gas or liquid to really serious energy,
except you need
it goes back to water, right?
Yeah.
And we're working out how to produce that. It's not pure. We call it industrial hydrogen, but a fraction of the cost. Where we've worked out already how to charge cars, not in 22 hours or even 8 hours, but in 22 seconds. Okay, and these are the fastest electric cars in the world, like Formula E winners all the time. We've worked out how to charge our huge trucks in 24 minutes. And I've had your US generals say to me, hey, look, you understand the US military can never go green. I said, why is that, mate? And they said, well, our tanks, they're 50, 60 tons, and they've got to go 50 mile an hour. And I said, well, hang on, mate, our trucks are 400 tons, and they've got to go 60 mile an hour. They're green. And they've said, well, shipping, our warships are like 100 metres long, Andrew. I said, honestly, mate, we could put 3 of your warships on the back of our iron ore carriers. They're 330 metres long, and we're sending them green. So everyone can go green.
I am curious if you guys are going to be also building wind farms, solar farms right next to some of your mines to help supply green power. Like, is that part of the process?
Yeah, it is. It is absolutely, and we'll supply power to us and power to others. Right now, we're operating a green grid. It's the first fully independent green grid in the world. It will be the largest, of course, because it'll be producing enough power the size of small countries, and it'll be a full grid, but it'll be off the standard grid, and that means that we can put this all over the world.
I want to come back to hydrogen because it's been talked about for many years. There's been a lot of money put behind it, yet to yield results. Where are the obstacles there? How far away is it from being something that's going to be widespread available and more heavily used as an energy form?
Okay, the only thing stopping the production of green hydrogen in North America, I mean, let's just remember that there's more people employed in the renewable energy sector in the fossil fuel old state of Texas than there are now is by fossil fuel. Yeah. So everything is changing. What we're seeing now is the whole growth, this massive growth of green hydrogen, green energy being held up by perfect getting in the road of the good in the IRA. And if we don't fix what a little thing called 45V, which is where the fossil fuel sector's got these environmental independent lobbyists to say, hey, look, we should have things like hourly matching. Well, okay, that's so perfect.
Parts of your own industry are working against this.
Yeah, I mean, but it's not my industry. It's the environmental lobbyists paid by fossil fuel. It's the same draw card, same playbook as tobacco use. They get so-called scientists in to say tobacco doesn't kill you, mate.
So it's money again, it's politics and it's lobbying.
Yeah, and we have to, Carol, look straight through that and say to your legislators, and your legislators have got to say, actually, we're not going to let perfect kill off the good. We know green hydrogen is the answer. We will have weekly matching or monthly matching, but hourly matching just means the person who came up with that's never driven or operated anything more complex than a bloody computer, not these 1, 2, 3 mile long plants, which I have to operate.
So 30 seconds left. Are you more optimistic after your time here in New York and talking with global leaders, North American leaders, U.S. leaders, or are you more pessimistic, just quickly?
No, I'm more optimistic. About
the shift?
Because they trust what someone does more than what someone says, and they can see we're doing it. They can see Australia's highest shareholder return company ever is going fully green, and there's got to be a reason for that, and they're making huge sales and they're profitable.
So we wanted to be smart and fun when you came in. Did we do it?
Yeah, you're smart and fun here. I love Bloomberg.
Such pressure. Andrew Forrest, thank you so much. Executive Chair, of course, of Fortescue, joining us right here on Bloomberg Business Week.
You're listening to the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, by now you know we are all in about global climate challenges this week. Adding to that task, crypto mining. A recent IMF working paper found that crypto mining could generate 0.7% of global carbon dioxide emissions by 2027.
Look, the IMF noted that because of the electricity used by high-powered equipment to mine crypto assets, one Bitcoin transaction requires roughly the same amount of electricity as the average person in Ghana or Pakistan consumes in 3 years. Something that's captured the attention of both US presidential candidates.
It certainly has. So crypto mining's energy usage was where we wanted to start with Rustin Benham. He is chairman of the U.S. Commodity Futures Trading Commission, the CFTC. He joined us from the Bloomberg Global Business Forum in New York City this past week.
Look, we're talking about climate issues first, and this is why we're thinking about the impact of crypto, but also more broadly, this is an area that you have lots of tentacles in your regulatory position. Talk to us about the question of environmental impact when it comes to crypto. Where are we thinking about regulation around that? What sort of rules are needed? What does the CFTC have power over?
Well, before we even get to the climate impact of crypto and crypto mining, I think the larger question in the U.S. is the regulatory structure, or really the lack of one. I've advocated for almost 3 years now that there's a gap in regulation, and this is just a product of the way the U.S. regulatory system is set up. Multiple agencies, couple market regulators, banking regulators, and for better or for worse, we've seen a sustainability in the marketplace, sustained demand by customers, both retail and institutional. And really what we have to do is make sure that we regulate it properly so that customers are protected, market stability is there, market resiliency. If we can get there, and I think that would be my priority, then I think the conversations about climate impact, energy usage for mining are important to ask and answer, and I think those have been actually within the domain of questions asked over the past couple years. A couple efforts by some of the miners to co-locate near power sources that are renewable or even nuclear. Some other efforts to change the way mining is done to reduce the carbon footprint. But as we worked with Congress over the past couple years to think about legislative efforts, I know this issue specifically was on their mind, and they wanted to think about disclosures, transparency, information to get to the market so that those economic incentives and preferences can essentially be manifest through decisions about what tokens to buy or not buy.
Well, on the energy component, so much an important aspect of the reliability, right? Making sure that it continues to work. I want to go back to the regulatory side. Donald Trump has kind of come out and said he's a friend of crypto. It seems like Kamala Harris's campaign is increasingly embracing towards the crypto world. In terms of your push for more oversight of the crypto world, would you continue to do so under a Harris administration?
Yeah, and I just, to be clear.
No matter who, and as friendly as they might be.
Yeah, to be clear, it's oversight driven by regulatory protection and customer protections. This is not me as chair of the CFTC advocating for the industry, saying that crypto is going to be the next great thing. This is about my observation as the head of a market regulator, saying there is a giant gap in regulation. There are a lot of customers who are either uninformed or don't really know the associated risks with crypto. And we have to put the guardrails around this industry. And those guardrails are the same guardrails that we put around equity markets, derivatives markets, fixed income markets, et cetera.
No different.
No different. But we have to think about, look, there are going to be differences on custody, cybersecurity. There are components of the financial asset, digital assets themselves that are very unique from securities or derivatives. There's no doubt about that. But if we think broadly from a principles-based standpoint, the market structure components that have been put in place for decades and have worked quite well for US markets are the same ones we need to think about for digital assets. Because there's a lot of questions about the sustainability of digital assets, but here we are, 2024, moving into 2025.
Post-FTX.
Post-FTX, other crises, Binance, a lot that we have brought on the enforcement side. And there is still, I don't know about insatiable demand, but there is still demand from retail and institutional, and they're looking for regulatory structure so that they can increase those flows.
How open is the industry to regulation? I mean, it's obviously a conversation that's ongoing, and you've outlined the complexity of how the different agencies work on this front as well. Are they engaging? Is this something that you're actually able to see productive results that won't end up in a risk of over-regulation?
Yeah, so this is really the tricky part of this, because I think, I argue this often, the US capital markets are the best in the world because of the regulatory structure we have, because of the legal structure we have, because of the accountability there is for bad actors and those who violate the law. So there are many actors, I can't speak for the entire crypto community, but there are many who have been very engaged with Washington, both in Congress and the executive branch, to see what kind of regulatory structure could work around digital assets. Will this benefit them? Most likely. I've said this publicly in the past. Again, to my point, US regulation is the reason in part why US capital markets are the strongest, deepest, and most liquid in the world. So they see a benefit to regulation. The word often thrown around is legitimacy. But again, I want to pull back to what my responsibilities are: protecting customers, protecting market resiliency, and in essence, sometimes financial stability. And as I continue to see this market ebb and flow and go through its sort of organic growth, I can't help but raise a red flag and say, look, we're seeing this market grow. We need to protect customers.
Russ, what would you say in terms of the powers that are necessary in order for any kind of regulation over crypto by the CFTC to really work?
Yeah, this is a unique part. Like, we have two market regulators, CFTC, SEC.
Right.
There is a question around some tokens. I've articulated and advocated that Bitcoin and Ether are commodities under existing law. Congress wants to change existing law. That's
we
fine.
still debate.
Sure. But look, we've brought a lot of enforcement cases, and we bring them through, the authority we have over commodity assets, which in many cases is Bitcoin and Ethereum. But ultimately, it's registration of exchanges, it's registration of broker-dealers, it's registration of custodians, clearinghouses, data repositories. The same, again, core components and core regulatory tools that we use. And with those registration requirements come ability to surveil markets, ability to collect data, and ability to examine market participants.
From what you're hearing from the election campaign, because we ask about it because it's coming up with alarming regularity, some would say, in how often it's mentioned. What are you hearing that sounds like a good idea or that sounds like a bad idea in terms of where regulation should be going from here?
So look, we don't want to undermine existing law. We don't want to change existing protections that exist for markets like derivatives, like stocks and bonds. We want to apply what we've learned and what we have in terms of authority to regulate markets to crypto. And it's about engagement. It's about understanding what the technology is. It's understanding what new risks or new variations on existing regulatory tools we would have to apply. But I often go, and I've had conversations with lawmakers in both the Senate, the House. There have been a lot of really interesting efforts, and credit to those who have led the way in both the House and the Senate to draft bills to contemplate giving the CFTC the authority. It's a unique circumstance where the CFTC regulates commodity derivatives markets, but not the underlying market. So we have this gap in commodity cash markets or spot markets, and this is where we find ourselves with digital assets.
All right, so we're still trying to figure out digital assets.
Yeah.
Let me throw artificial intelligence into the mix, right? Increasingly, not new, finance community has been using it for a long time, right? I do wonder if you guys are planning what tools you need to have in place to kind of oversee that aspect of our world.
Yeah, it's an important question, and at this point, almost 9 or 10 months ago, we put out an advisory, a request for comment, a consultation document. And in my mind, the steps we needed to take as an agency was one, information gathering, engagement, getting better and smarter ourselves so that we can think about what existing rules apply to AI and where there may be gaps in the space. So we're working through some of those comments. I'm hopefully going to come out with some form of advisory guidance in the near future, but it really is contingent on us being thoughtful about how AI has been used thus far and how it may be used in the future.
Are you talking to big tech about this?
When we consult, we cast a very wide net. We want to learn from everyone, and that not only includes the individuals who are directly registered or participate in our markets, but it certainly is the tech companies who are building these AI platforms and models that are essentially being used by the financial institutions.
The CFTC recently put out guidance on voluntary carbon credits. I'm curious about the voluntary nature of that and whether that's something that's going to be relevant and enforceable, given that that's the framing that we're given on this area.
Yeah, so not unlike crypto in some respects, we've seen voluntary carbon credit futures contracts listed over the past couple of years, derivatives. And once we have futures and derivatives listed on our registered exchanges, I use this phrase a lot, we have, as an agency, a vested interest in the health of the underlying market. And in this case, it's a voluntary carbon market. We want to make sure there's resilience and health and high integrity in that cash market so it's reflected in the markets we regulate. Ultimately, from a broad perspective, if we're going to transition and hit our 2050 targets, our 1.5 target, we're going to need voluntary carbon markets. We're not going to be able to wean ourselves off of coal and some fossil-based, carbon-based energy sources. So we're going to need a way to allocate capital, transition to the global south and other nations that need to transition to low carbon intensive energy sources.
20 seconds election betting. I know you guys don't like it. You recently lost a court case very quickly. Nothing you'll warm up to.
It's not about what I like or don't like. It's not about what the agency likes or doesn't like. It's about what the law says. And the law, in our view, says that election betting is against the law.
All right.
Russ Benham, thanks very much for joining us, CFTC Chair.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
The Reserve just announced lowering interest rates. I predict they'll go further down. We should give business even more confidence to invest trillions of dollars that are on the sidelines in the clean energy industries of the future.
That is President Biden at this past week's Bloomberg Global Business Forum in New York City, shortly after he gave his final speech as President of the United States to the UN General Assembly. President Biden was among the world leaders that were in New York City this past week for Climate Week and the UN General Assembly. Top of mind for many, actions and investments in renewable sources of energy and ways to tackle the climate crisis.
The banking sector was in attendance as well, concentrating on financing climate solutions and more of those same solutions. The sentiment voiced by Standard Chartered CEO Bill Winters, speaking from the Earthshot Prize Innovation Summit.
The only way that we're going to be successful in the fight against climate change is to offer people an acceptable return. It doesn't have to be a grotesque return, just acceptable. That's the only way to move trillions and trillions.
One of those sources of clean energy that countries are continuing to invest in, and the finance community is certainly looking at, is wind. The World Economic Forum says that in 2023, last year, the global wind industry installed a record 117 gigawatts of new capacity, a 50% increase from the previous year, and that countries across the globe are investing in both onshore and offshore wind capacities. China leads the pack, adding to substantial new capacity annually, supported by ambitious governmental renewable energy targets under its 5-year plans.
Ben Backwell's the CEO of the Global Wind Energy Council, an international organisation dedicated to promoting wind power as a key solution for the global energy transition and to combat climate change. He's also a journalist. He's written books, including one entitled Wind Power, the Struggle for Control of a New Global Industry, and another on offshore wind. Ben joined us from the Bloomberg Global Business Forum in New York City.
The good news is that we're going quite fast in terms of expanding. As you said, a record year, and we expect to break those records every single year going forward.
Yeah.
The bad news is that we're not on the trajectory to triple renewables. We're probably on a kind of doubling trajectory by 2030. So we go 117 last year. We think we're going to be at 130 this year, 148 next year. So it's building. But we probably need to be growing about maybe twice as fast to be on a net zero.
Why aren't we?
Well, there's a number of reasons. I think the main reason is that everything is just too slow. So planning around the world continues to be a barrier. I mean, it takes twice or 3 times as long to plan and permit an offshore wind farm than it does to actually build one. Mm-hmm. So in terms of the technology, the capacity to build, it's there. In terms of red tape and bureaucracy, we've got a long way to go. So that's probably number one. And then secondly, we're facing some market imbalances as well. I mean, there's been kind of race to the bottom pricing in some areas, which has then led to the projects not being profitable. We've had a bout of inflation. You've seen in the impact a year ago in the US. Some of the projects had to go back and renegotiate because of inflation. So there's some new kind of headwinds, but we're speeding up and we're going where we need to.
What about public money incentives and all of this as well? I mean, it's something that, we think about the Green Deal in the EU, Inflation Reduction Act here in the US. Are the public incentives actually doing the job they're supposed to in boosting expansion, or is it being undone by the obstacles that you're talking about?
So generally, we don't need subsidy financing for the projects, right? Because our levelized cost of energy is competitive with pretty much anything out there, especially vis-a-vis oil and gas fired projects and nuclear. So generally, we don't need subsidy. Having said that, there's places, especially in the global south and the emerging world, where they're just getting started, and where the initial projects will be more expensive than the projects in the mature markets, right? So if you think of somewhere like the Philippines and Southeast Asia, I mean, they're starting from a virtual standing start. They've got to build the infrastructure, they've got to build the grid, they've got to build the ports. And so there's a kind of gap, I think, in financing for some of those emerging markets, countries.
Where's the growth, onshore, offshore?
So onshore is still the biggest part of the market, but offshore is growing faster. So the compound growth rate for offshore is faster. Onshore is still 85% of the market. And what's interesting is that the onshore market is really picking up again with new countries. So Germany's really speeded up. The US, we're expecting to really speed up from this year onwards, right? So the IRA has had a transformative effect on the onshore market. It's taken a little bit longer than we thought, but we can really see now the construction starting, a huge amount of projects in construction. So from next year, we'll really start to see the US onshore market really take off. And then there's India speeding up as well. Australia's doing really well, and there's a bunch of new markets that are growing as well.
The red tape issues that you talk about, what is the message you're getting from policymakers on that? I'm sure this is something that you're engaging with them regularly on it. You were speaking to leaders here at your event here too. I'm keen to know how exactly that conversation is going. Is it coming back to people don't want wind farms near their homes? Is it much more complex than that? Is it a systems problem? Where's the roadblock?
I'd say it's mainly a systems problem, and there's been quite a lot of recognition around this problem for the last few years. I mean, we started at COP26 in Glasgow 3-4 years ago. We started really trying to put this on the agenda. It kind of sounds like a bit of a boring issue, and so it's kind of hard to get people's attention around it. It's about permitting after all. But it's pretty important. And what's happened since then is a number of countries are passing new regulation and new laws. For instance, in Germany, I mean, they've now made permitting offshore wind farms what they call overriding national interest. So that means that in the legal system, unless there's a very good reason to object, the project will be approved, right? So changes like that are good.
I wanted to ask you about a particular issue that came up in Europe this summer when we had such production coming out of particularly Spain and Norway that the price of power dropped below zero, which kind of sounds in some ways like a huge triumph, but doesn't make for a great business case. How do you sort of address that problem, which is down to storage, really?
Yeah, I mean, I think it's a real problem, and I'm seeing it, as you are, in more and more markets at different times. And it's partly a function of having just a lot more variable power on the system, so a lot of solar and a lot of wind, and which means that at certain times of day you've got a real abundance of power on the system. But it's ultimately down to two things. One is the market design, to make sure that the market design is kind of built around those new sources of energy. And secondly, it's about interconnectivity. So obviously the more connected you are, and this goes to Iberia, right, and Spain and Portugal, the more connected you are to the rest of Europe, the more the market will work in a balanced way, right? So we've got to work more on grid connectivity and connectivity generally around the system, right?
In the United States in particular, I spent a lot of time on the water, and for the first time saw, the turbines off of some of the islands in the United States. But I just do wonder, there is a pushback, it feels like, whether it's, Nantucket or Block Island or something, where people are pushing back on some of these. How does that perception change in the United States? How do we get there?
Yeah, I mean, I'd separate two things maybe. So the first thing is people's genuine concern over the impact and the impact on nature,
environmental,
which as an industry we're very attuned to. And after all, most of us are here because we care about climate change and the environment, and so we want to do things in a way that's the best possible way possible. The offshore wind farms are nature positive and so on. So that's genuine, and I think the way to do that is to ensure the highest quality, the best standards of consultation, working with communities, and so on. Now, the other issue is disinformation, and organised disinformation, I think, is something that the renewables industry as a whole should be paying a lot more attention to, and civil society, journalists, editors should be paying a lot more attention to. I mean, we've seen organised disinformation around offshore wind, so the idea that offshore wind is somehow killing whales, even when there was no construction going on at that time, and organised disinformation with AI-generated images purporting to show marine wildlife that's been harmed by offshore wind. That has then copied and pasted to places like Australia. It's been copied and pasted into places like Europe.
Right.
And that's disinformation.
That's another conference, the misinformation that's out there, like pick your industry, right? It makes it much more difficult. Ben, thank you, though, for finding time for us.
Thanks very much for having me.
Yeah, we appreciate Ben Bakewell, the CEO of the Global Wind Energy Council.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
All right, so before Stephen and I wrap up this week, we wanted to remind everyone about the mission the world is on to combat climate change. Toward that, renewable energy goals were set at last year's UN Climate Summit in Dubai to triple global renewable energy capacity by 2030.
Look, the International Energy Agency has warned that it's unlikely to be met without major policy action supporting wind and solar energy. We heard that from Ben Bakewell. Wind energy capacity has been doubling, not tripling as many hoped it would. So for more on whether this 2030 goal for renewables is at all achievable, we spoke with David Cherney, clean energy policy leader at the global consultancy firm PA Consulting.
It is going to be quite challenging to triple renewable capacity globally. Certainly, I think everyone's going to give it their best shot. Here in the United States, we've had a tremendous amount of new clean energy come onto the grid over the last decade. Nearly over 100 gigawatts of wind, solar, and other clean energy technologies. So the ball's moving in the right direction. The question is how rapidly is it going to move down the field?
All right, so talk to us a little bit about initiatives in the United States. I've been out in the water, seen the windmills. I feel like wind energy, though we continue to see some pushback. And it is curious to see, what the elections bring in terms of the White House come November and what that means for alternative energy policy. Let's maybe start there. In terms of the political environment, are you nervous about investments even in the U.S. slowing down specifically because of what might happen come November?
Certainly what comes November is going to have an impact on specific investments, right? So there will be winners and losers whenever we have policy change. And it's a really important point, but I think we need to think about the big arc as well. So if we look back over the last 20 years and we sort of use 2005 as the marker. So for the United States, that's when we had the largest amount of carbon emissions from fossil fuels across our economy. We've been declining on average about 1% a year across the economy pretty consistently from the Bush administration through to the Biden administration. So we've had pretty consistent declines. A big part of that has been the deployment of renewable energy. It's also been the downfall a bit of coal generation as that is retired from the system. And so as we think about November and what's going to happen in the near term, so thinking about the next 4 years, really we're probably headed on the same trajectory, 1% decline per year. It's pretty hard for a presidential administration to cause a shift in what we see on a dime. It'll take some time for policies to play out.
But one of the big policies under this administration was the Inflation Reduction Act. Amounts of money never seen before being pumped into clean technology. Has that just not been effective enough?
Well, it's a good question, Stephen. And I do think it's actually been pretty effective. And the question is sort of, again, what are our expectations in the short term? And certainly extending tax credits for wind, solar, adding in storage to those types of tax credits. So production tax credits, investment tax credits is really helpful at moving the ball forward with wind, solar, storage, and technologies of the like. The Inflation Reduction Act, while it's named the Inflation Reduction Act, it certainly is one of the most important, if not the largest piece of energy and climate policy that the U.S. has seen in decades. And really, when I think about that policy, it's not just thinking about the near term, sort of changing things on the dime, it's a long term. It's going to be really challenging for us to meet the climate aspirations that we have set as a nation and frankly, globally, without innovation. So we're going to need new technologies besides wind and solar to get to where we want to go. And so the Inflation Reduction Act has created incentives for things like green hydrogen, carbon capture, storage technologies, offshore wind, advanced manufacturing, electric vehicles, and the like. And certainly we can't predict today, 10, 15, 20 years from now, what is going to be the technologies that are the winners. But we're planting a lot of seeds, both in terms of R&D, is also incentives to try to commercialize new technologies that can help us get to that last mile. And so really, both in terms of our power sector, as well as thinking about transportation, commercial, residential, it's innovations to come that the Inflation Reduction Act is really going to push forward. Certainly the near-term push is helpful, but anyone who had expectations that we were going to see a massive shift in a year and a half since the passage of that act, I think was misguided a bit from the start.
Hey, David, I do wonder, what moves the needle most when it comes to renewables and green energy? Is it the economic environment? Is it the cost of energy? Is it the cost of capital? Is it politics? What is it in your consultation and what you folks do in the United States and around the world? What really moves the needle in making changes towards renewables?
Carol, it's a fantastic question. The answer has changed over time, right? So if we were to go back 10, 15 years ago with renewables, thinking about wind and solar, certainly state level mandates, targets, renewable portfolio standards for these technologies were really helpful in getting the ball rolling. Similarly, R&D dollars put forth both in private industry and by the federal government have helped innovation, bringing costs down. And I'd argue today it's about the economics at the end of the day. So while we've seen some increase in the near term in the installed capital costs of these technologies due to global challenges with supply chain that we've seen across industries, on the whole, we've had massive declines in the cost of modules, the cost declines in turbines, and the like. We've essentially been able to deploy more and more of these technologies as they become more and more cost competitive. And I think a good example, right, is to look at Texas, which has a renewable portfolio standard from more than a decade ago that was surpassed more than a decade ago, and we keep plowing in more and more solar and more wind into that market. And it's not driven by policy goals for specific amounts of these types of technologies. It's the economics. It's a cost-effective place to build those technologies, and the demand is there.
Right.
But which direction does the economics need to move in to make that process speed up? Is it that everything else has to get much more expensive so that people go to renewables, or is it that the cost of production for these technologies needs to come down?
So it's a mix. We are going to continue to see the growth of renewables, so wind and solar. But I think we all recognize that wind and solar only produce electricity if the wind's blowing or the sun's shining, right? So there's a bit of a tautology in that. And what we really need to maintain reliability in a cost-effective manner is dispatchable technologies that allow the system to balance itself. And so really this is where a lot of the innovation is needed, is clean technologies similar to nuclear that can provide baseload, clean energy, or cleaner dispatchable resources that can help balance the system. And so in the near term, a big part of that has been natural gas, and it's going to continue to be natural gas.
All right, we're going to leave it on that note. David Cherney, thank you so much. Clean energy policy leader at PA Consulting. They are a global consultancy firm joining us from Colorado.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.